Hello and welcome to Real Insights. Today we're talking with Chris Bennett, Managing Director and Head of the London branch of Dekabank.
Hi Chris, welcome to the Real Insights podcast.
Hi Sam, how are you? Happy Monday.
Yeah, happy Monday to you as well. So today's Real Insights episode is on commercial property lending, particularly how this market has evolved over time, and specifically today, the distinction between regulated lenders, which are called banks, and non-regulated lenders, particularly private credit. So maybe to start with, if you want to give a little bit of background about yourself and your role with Dekabank and your career.
Of course, I'd be delighted. So I'm the head of Dekabank's London branch. Deka may not be a name that's overly familiar to many of your listeners. It is and there's a good reason for that. Deka essentially is a privately owned German commercial bank, fund management house, and capital markets business. And we have a very small percentage of our business which is overseas. We've been in the UK since September 2008. I'm going to talk about this in a second. And I've been with the bank for the entire period of time. I have another hat which I put on very occasionally, but which I think is very relevant to talk about now. I am the immediate past chair of Crefc Europe, which is the Commercial Real Estate Finance Council for Europe. Crefc is the, I would say, the major commercial real estate finance trade body with a very, very big membership base in the United States. And again, similarly, and again, relevant for what we're going to talk about today, Crefc formed in the UK as a response to the financial crisis. So those are the two hats that I wear. Obviously, my time at Dekabank has seen lots of change, and maybe I might take you back to the beginning in terms of why I ended up being a real estate professional, because again it has echoes on the past. So I started my commercial real estate finance career in 2000, and I think I was quite unusual. I came out of an academic background with a very heavy focus on mathematics. I did a maths degree, I did an accounting master's, and I sort of pitched up into commercial real estate lending, not really knowing what it was. And at that time I think it's probably fair to say it was a relatively, let's be fair, it was a less sophisticated market than it is now. And certainly with my background was quite unusual. I know that you're a CFA, and it's great. We have a lot of really talented people who come from a very strong numerical background who are in the industry now. That definitely wasn't the case when I started off. The letters that you tended to see behind people's names weren't CFA or ACA. It was more MRICS or FRICS. So the market was it was dominated by ex-surveyors. Certainly, commercial real estate lending market was dominated by ex-surveyors, and as a result of that, and as a result of how I felt about my background, I actually trained to become a surveyor, and now have that qualification. I became a qualified surveyor in 2014, in addition to my sort of numerical background. And I would definitely recommend to anyone who's listening to this podcast, become a surveyor. It's a great qualification. So look, maybe we'll just sort of talk about what the market looked like when I started in 2000, because it is very, very different to where we are today. Commercial real estate finance was essentially a bank-led product. I mean, there were other providers in the early 2000s. There was a little bit of CMBS. We'll come on to that in a second. But essentially, it was provided by banks, and I think it's a little bit unfair to call it an offshoot of what the Americans called the 363 Club. So the 363 Club, I think, was a name given to commercial real estate lending in the United States in the 1980s. Borrow at 3%, lend at 6%. Get on the golf course by 3 p.m. Right. It's a little bit unkind, and it's one of the reasons why one of the reasons linked to the savings and loans crisis in the United States in the 1980s. But let's leave that to one side. In commercial real estate lending in the early noughties was relatively unsophisticated. It was essentially banks taking their short or medium term deposits and doing, as I've just said, and lending them and trying to get a spread between the rate at which they borrowed or took deposits and the rate at which they lent money. In the early part of the millennium, CMBS, commercial mortgage-backed securities, arrived from the United States as a different funding route, and it ramped its way up to from around about 50 billion euros of issuance per annum. So it's a really viable funding route, and we saw all of the major shops, all the major investment banks setting up platforms in the early part of the millennium. Anyway, long story short, we ended up in the global financial crisis, and I'm sure some of your listeners will remember the period of time from late 2007 through to September 2008, where we saw whole-scale bank failure, starting with Northern Rock in the UK, and then ending up with the failure of Lehman on 15th of September 2008. Now, that was a very, very prescient day for me personally, because that's the day that Deka started its activity in the UK. And I remember my boss at the time, Mark Titcombe, saying, the office is now open, your contract is now live, the markets are crashing, I'm going off to play golf, it's up to you what you want to do. So faced with the choice of potentially not having a job on Monday morning, allied to the fact that I got the opportunity to work back in a conventional real estate lending platform and to work with Mark, it was a very, very easy decision for me to take.
And was there a link between Deka launching in September 2008, or was it just a coincidence in timing that they'd been planning to launch and then things started happening around that?
That's a really good question. So obviously my board members are geniuses and foresaw the full extent of the financial crisis and realised that we would be incredibly well positioned. No, that's not true. Deka had historically been a lender, effectively a domestic lender, supporting the German open-ended real estate fund. So Deka's major real estate product is open-ended real estate funds, which they sell to via our shareholders, the savings banks, which they sell to retail investors. And our lending business originally was designed just to support those lending activities. And in 2006, 2007, 2008, the board decided that it would like to carefully grow its real estate lending platform. And the London office was the fifth out of a series of overseas representative offices that the bank opened up. And we opened up just completely by coincidence on the day that Lehman filed for insolvency. On the 18th of September 2008, post-Lehman, there really were not a lot of banks that wanted to lend on commercial real estate. A lot of banks, in a not too dissimilar way to what we've seen over the past 18 months. And there are echoes of the financial crisis in terms of what we've seen. A lot of banks had bloated balance sheets, were struggling to work out. So they had both funding and solvency issues. And Deka didn't have that issue as a bank that, relatively speaking, didn't have very much exposure to commercial real estate lending. And you know, in that sort of first couple of years, the market really was very thin in terms of availability of credit, and those that were providing credit tended to be of a similar ilk to us. So the German lenders in the period immediately post GFC were quite prevalent. And the other differentiator that the German banks had and still have, but it was particularly prevalent post financial crisis, was being able to use the fan brief. I don't know if you know what fan brief is.
No.
Okay.
No, you have to explain that
Okay.
to me.
Another relatively esoteric topic. Fan brief is effectively a German covered bond, and going to get dates wrong. So apologies anyone who has the Fan Brief Act to hand. Fan Brief has been issued for over 100 years. Has never had a default. So it's super secure, very, very liquid, and effectively what it allowed the German lenders to do was to get funding for their commercial real estate lending program, because post financial crisis, and we saw it again in COVID, and we see it whenever we get a liquidity squeeze. If you can't fund yourself, you run into difficulties quite quickly. So life as a regulated lender is quite complicated.
Mm-hmm.
You're a relatively delicate ecosystem. You're trying to manage two things at once. You're trying to manage the size of your balance sheet together with how you fund yourself. And because the fan brief market enjoyed a significant degree of support, German lenders were able to get access to funding, so they could fund their commercial real estate lending programs. And the combination of efficiently priced fan brief and an advantageous reg cap model
Mm-hmm.
has meant that the German lenders were able to be quite a relevant part of the commercial real estate lending market immediately post GFC. So sort of spinning forward as the market developed, and we had a really long cycle. This last cycle was extraordinarily long. Again, we probably won't go into the reasons for that now, but quite unusual to have a kind of essentially a sort of 13, 14, 15-year rate cycle.
Yeah.
And I suspect we'll see a much shorter one in the next cycle.
So that would be sort of 2009 to 2022.
Yeah.
Rates
Yeah.
generally
Pretty
coming
much.
down.
Yeah. So the market developed, the commercial real estate lending market developed over that period of time, and the advantages that the German real estate lending community had started to be eroded by the mid 2010s. UK clearing banks have always, and I suspect will always continue numerically to have a dominant market position. But we also saw insurance companies ramp up the size of their activities. And again, there's quite an interesting, in my opinion, I could be completely wrong, there's quite an interesting read across from insurance company activities pre and post GFC. So the insurance companies were big buyers of commercial mortgage-backed securities, AAA debt.
Yep.
And they decided that what they would do is originate for their own balance sheet. So effectively, they kind of swapped out of, bond products into loans. And there were a couple of reasons for that. One was that the experience that they'd had in the GFC was not good. So they, for European CMBS, it because the market cycle was very, very short, 5 years, the buyers of that paper had a good experience, or as good experience as they'd had in the United States. Second reason was the regulatory treatment of bonds versus loans changed, so it became disadvantageous to hold a commercial real estate bond. So mid 2010s, the market again is continuing to grow and evolve, and it was around about that time that I really realised I didn't have a very good picture as to what was happening in the commercial real estate lending market, but I knew that it was changing. And then we have this final element, which really, I think, post mid 2010s, and certainly over the last 3 or 4 years, has become the growing and one of the more dominant parts of the market, which is private credit.
Yep.
And the private credit space has changed in all recognition over the last 5 years. And I think there's some really interesting structural drivers for why private credit is interesting right now. But my personal feeling is that private credit is probably sort of, if you look at the Bayes, the latest Bayes report, I think private credit makes up about 20% of the market.
Okay.
They have eroded into all areas of regulated lending, and particularly our part of the commercial real estate lending market, which is quite unusual because the reality is that they're not directly competing against us. They're looking for a slightly different return. They're able to take a greater degree of risk, but even that may narrow up over the course of the next couple of years for some good and interesting reasons. So here we are today, a very well diversified market, both in terms of number of practitioners, but also the type of capital that they're able to deploy. And I might just sort of end this little bit by just doing a compare and contrast as to where we were in 2000 and where we are in 2024. It's a radically different market, and I think it's good. The market is very well diversified. It's very mature. I think one of the things we need to look out for is the fact that back in 2000, pretty much every lender could fund the same kind of product. So you weren't just restricted to residential development or commercial real estate finance and offices. Your reg cap tools and your risk allowed you to look at a much greater subset within the CRE space. Now that's not the case, and the slight concern, and maybe something for us to think about in the future, is availability of credit right the way across the CRE space. But I think generally speaking, we've got a very healthy and vibrant market.
Okay. Yeah, that's interesting. Really, really nice summary background of.
It was the longest summary I think you've probably ever heard.
it's a long period from 2000 to 2024, and it includes the GFC. So there's a lot going on there. So I think maybe if we look at a recent example was Silicon Valley Bank, and I think it was March last year. So to sum up simply, they were sort of had short-term liabilities in the form of deposits, and they were lending, like buying longer-term duration kind of bonds. And that's what you were saying, that traditional.
It's kind of like this 363
banking type model, and so they obviously got into trouble when interest rates went up and their duration kind of play.
So maybe we'll take a look at funding again a little bit, and remember, just sort of we talked about reg cap and balance sheet management, but funding is another really important part of commercial real estate credit. And conventionally, banks fund short, lend long. Mm-hmm. So if you are particularly the UK clearers, that is the predominant, not only, but it's the predominant part of their funding model. I think treasury functions are becoming increasingly sophisticated and are able to swap out short-term borrowing exposure to make sure that they effectively match fund larger proportions of longer proportions of their book. But SVB, from my view, and I'm definitely not an expert, was a classic example of a short-long model going wrong because of a change in the interest rate environment. And that is, we saw that in the UK as well with the LDI pension schemes around about kind of the time of the Liz Truss experiment. And it's quite a classic thing. If you've effectively borrowed some money at 0.5%, and now the person who's lent you that money says, well, look, I can still let you borrow the money, but it's now going to cost you 5%. But you've lent that money locked in for a long duration at 1.5%. You've got a big problem. You have a really big problem. So that's effectively what happened.
Okay, and so this model where most of commercial property loans are coming from banks that are funding short and lending long term, that was, would you say, a characteristic of a less sophisticated market?
Definitely, absolutely.
And today, what do the more sophisticated European balance sheets look like relative to that model?
That's a really good question. So our balance sheet management hasn't changed that differently. So that to that much of a great extent over the past 10 years or so. But we're about to see another very large change with the latest BAL iteration that comes into effect, I think, in 2028. So effectively, we have quite a sophisticated way of managing risk. And kind of the easiest way of describing it is when we write a commercial real estate loan, without giving you too much of the IP here, our reg cap tool effectively finds a way of proxying the risk to a commercial bond. Okay. So we have stratifications of risk that run from AAA through to for us, kind of non-investment grade, and we probably don't look at anything which is non-investment grade, and we have stratification all the way throughout that. And the closer you are to AAA, turn it around. The further away you get from AAA, the more capital you have to lend, and that's fairly typical right the way across the European lending markets. So the the European CRE space. UK clearers are, as I say, they're using the slotting tool, although there is some conversation to say that the slots may be relaxed. And we're also using dynamic treasury functions. I would say that it would be unusual to think that banks are now just solely relying on short-term deposits as their principal way of funding themselves. Banks are very sophisticated now. They are able to correctly and dynamically ascertain what the balance sheet is, what the true return on equity is for that loan. So I know for us, again, without giving away too much of the IP, whenever we write a loan, we're able to project the ROE for the entire project with a great degree of accuracy.
And Chris, you mentioned your involvement with the Commercial Real Estate Finance Council, Crefc. I've seen a little bit of back and forth between some comments by the ECB on the state of the commercial property market in Europe, and some replies from various bodies like INREV, Crefc, and a little bit of debate between those two organisations as to the risks in commercial property at the moment. So I was just wondering if you had some comments on that.
So I've got to be a bit careful with what I say here. So look, if we think about the reason why the regulators wanted to have reg cap models in place, it was effectively to control the size of lender balance sheets to ensure that they weren't overly exposed to commercial real estate, because commercial real estate was the area in which most of the banks lost a significant degree of money in the GFC. But it was also to ensure that they were lending with the right risk criteria. And I think the thesis has been tested, and I think that generally speaking, and aside from some specific credit events, it has worked well. And I think the quid pro quo for that is the commercial real estate market remains healthy. In a market cycle where you see significant degree of dislocation of the type we've seen, it wouldn't be unusual to expect to see lenders take some losses, particularly when you have kind of two things happening. So, and this is what we've seen happen which is quite unusual. We've seen both a cyclical change, market, kind of capital markets change, so interest rate environment and values changing, but we've also seen in certain sectors structural changes, and in certain sectors those structural changes have been good. For example, logistics sector, BTR, anything which kind of has a living component, life sciences. And we've seen post-COVID, we've seen some structural changes in the office sector which maybe haven't been as good, albeit I suspect that the office market, in common with the shopping centre market, which we might talk about downstream, might actually be a sector of the market which is oversold, because there is, as with all these things, there's stratification.
In terms of the quality of the assets within the...
In terms of the relevance. In terms of the relevance, definitely. But probably that's related to quality as well.
Okay. So maybe if we look at the rise of private credit that you mentioned as we come to current commercial property lending market today. So is it fair to say it's around 20% of total commercial property loans?
Yeah, I'm probably going to get told off for getting the number wrong, but I would say it's about 20%.
Okay, let's roughly work off that. That 20%, if we think of private credit, is generally chasing sort of higher returns, and
it's a good question. So historically, yes, definitely, but again, I'm not deep into the market, but this my understanding is that the private credit market is changing quite dramatically, and part of that is a function of some of the big US houses setting up platforms and having access to perpetual capital. So they have perpetual and cheap capital, and they're also using and able to use back leverage, which is effectively kind of loan on loan financing, which allows them to it means that their return requirements are significantly reduced from what they would have been 5-10 years ago, and it also allows them to scale up their activities in a significant way. So my understanding of private credit is that the private credit is essentially coming from different pathways. So a fund which whose LP investors may want to generate a particular return, and then this other source of perpetual capital. Anecdotally, I understand that some of the big US houses in particular have insurance company capital, bought insurance companies, and are using the float from the insurance companies to effectively invest in their CRE programs. And then you have this concept of back leverage, which is regulatory from a regulatory perspective. Again, regulation is everywhere. So even in private credit, it's regulation is really important. And what we've seen is certainly some of the big US banks, their regulator is allowing them to provide loan on loan finance, back leverage, in a far more efficient way. So they're using less capital than would be the case if they were just providing a direct loan on the asset. Let's put those two things in combination, allied to the fact that we've had this change in the market cycle where LP investors have probably said, well, there's quite a lot of risk here at the moment. I'd much rather be lower in the capital stack. Yeah. And private credit's had some very, very, very good tailwinds behind it. Again, allied to it would be quite natural at a time of volatility where there is a little bit of a credit squeeze for investors, direct investors, to effectively say, well, I'm quite happy to take my debt and not necessarily maximize the efficiency of pricing. I just want the debt, and I'd like to know it's there and at a reasonable rate, and that is something that private credit has been able to do.
Mm-hmm. So overall, would you say there is a more diverse range of options for people that want to borrow money to invest in commercial property?
Absolutely.
And that in and of itself is a good thing for a happy, functioning market.
I think that's, again, going back to 2000 and sort of looking at the various milestones, it would be difficult to argue that this is not the most diverse and not necessarily interconnected, which is good, commercial real estate finance market that I've ever seen. I think there's one missing. There's probably a couple of missing components. Essentially, there's no real capital markets activity in the commercial real estate lending space. There's no CMBS, there's no CLO. I think if you also add those products back in, then you have a very diverse and well-functioning commercial real estate lending market, which should ensure that you don't have any credit-related or availability of credit-related issues.
It's going to bring me to my next point. It's been pretty widely publicised about the volume of commercial property refinancing that's coming up in the next 2 to 3 years. So you would say that we're reasonably well placed given the diversity of options that wouldn't have existed, say 20 years ago. So the refinancing opportunities are much broader.
Yes, but it's a different environment. And 2008 was the global financial crisis. That was the closest comparator to what we have just seen, but it's not an exact match. Yeah. And there are two reasons why it's not an exact match, and this is relevant to refinancing. So in 2008, we went from high values to low values, but we also went from high interest rates to low interest rates, and we didn't have as developed a regulatory capital market as we do now. Whereas in 2022, 2023, 2024, we went from low interest rates to high interest rates, and the regulatory slots or buckets are that much more advanced. And what that has led to is that investors can be money good and lenders can be money good, but they're finding it difficult to refinance positions because either they can't do it from a reg cap perspective. It either is using so much reg cap because they are a long way up the LTV scale, or the debt doesn't service in the way that it did do in the old interest rate environment. And whilst I think there is a significant availability of credit, it doesn't necessarily mean that getting out of the previous vintage of loans is going to be straightforward. I would say that for me to feel very confident about that, it's not just the availability of credit which is the issue, it's the availability of mezzanine, pref equity to come in and right size the capital stack. And there definitely is that for certain projects, but for some projects, particularly where there are potential medium-term value issues, that's not the case. And again, as we said a couple of minutes ago, you have these two things that happened at once. You had the cyclical change and you had the structural change. And in certain sectors, in certain asset classes, where it's much more difficult to get a read on value, because of the sort of not necessarily knowing the future occupational relevance of an asset. Persuading equity to come in and recap or monetize a loan is difficult. It's difficult.
Yeah, no, equity is definitely a challenge at the moment. That may change as a lot of these LPs have been investing in private credit funds. Will start to look at equity again, and then that private credit space could.
Yeah, I think that's very fair. I think it's really fair, and we'll see what develops. I mean, there is, again, I'm not really fully in the detail, but from what I understand, there are investor buckets that just want to invest in fixed income,
right,
and see private credit as a proxy for fixed income. So I think it's fair to say that they'll probably remain in that space. But there's also LP capital, which is equity capital, looking for equity risk. Exactly. And as the market normalizes, I suspect we will see them saying, well, actually, this is a great time for us to be investing in the equity side of the capital stack rather than the debt side of the capital stack. Now, what does that really mean? It means that unless you have scale and critical mass and effective track record, and perhaps there's perpetual capital, then maybe private credit will not be as accessible as it has been in terms of being able to deploy. But I also feel pretty sure that the big private credit managers, and there are sort of 10, 15 of these now, are set fair in terms of their strategy and their model, and they will continue to be able to deploy. So I don't think it means private credit will just disappear. I think far from that. I think it's a really valuable part of our market and it's here to stay now. I just think the proliferation of private credit providers that we've seen recently, that will probably change. I think that will probably change.
Yeah. So the I guess the private credit and the attraction to private credit for investors or developers is potentially the speed at which they can lend. Yeah. There's less credit committees to get through. And also they may be able to go further up the risk curve in terms of LTVs. Is it? But I guess from what you've been saying, it's not quite as simple as the regulated lender lends the senior piece and then the private credit comes in if you want to go up the LTV.
It's correct. It's not quite as simple as that. Because private credit may want to invest right the way throughout the cap stack. So maybe the easiest way of describing the situation is it would be unusual within the core space for a core investor to want to take private credit in any part of its capital structure. So we don't tend in our part of the market, which is heavily regulated, investors looking for efficient pricing solutions. Quite frankly, they don't want to take private credit money because it's more expensive. But I would say that generally speaking, private credit from my experience, is able to access the broadest spectrum of lending opportunities because it isn't being directed into different buckets in terms of risk or sector. It can effectively look at things holistically and say, that's just a good real estate lending loan. And if you were to say to me, what is the biggest change between 2000 when I started, 2024 now, I see on a weekly basis plenty of loans which I say are, that's a really good real estate lending loan, but we can't do it because it doesn't fit either our risk parameters or our reg capital.
Yeah, it's why it's been sort of described as the golden age of private credit because of what's happened in terms of the kind of handcuffs that have been put on regulated lenders in a way, and how they lend. I think if you look towards the future, we have a really diverse, probably the most diverse commercial property lending market that we've ever had. You mentioned CMBS, and you'd like to see some holes filled from debt capital markets. Is there any other sources of credit that you see needing to come in, or you'd like to see in the market in the next 5 years?
I think CMBS or CLO's collateralized loan obligation. I think we're going to get, we're going to go down the rabbit hole if we start talking about what that is. But if we just talk about a capital market solution, effectively a bond market solution. Now, there's a reason the bond market works really well in the United States, and it's scale. You've got very, very large assets, hundreds of billions of dollars worth in value, where a bond market solution is more relevant. We don't really have that in the UK or in Europe. You can sort of get to it by putting assets together, but maybe one of the sectors where it is most relevant, and I'm kind of sort of thinking back to pre-financial crisis, CMBS was very effective at financing shopping centres. And shopping centres is a part of the market which is particularly unloved for credit at the moment. But it's also one where I think there's a great opportunity because there has been such consolidation in terms of both value and income stream, and values are, provided you can underwrite your scheme properly and be quite confident that the value journey doesn't end at zero, it ends at sort of where we are now and potentially goes upwards, then shopping centres, certainly super regional shopping centres, offer the opportunity for CMBS issuers and investors to issue debt, pay the investors a reasonable coupon because centres are trading at a significant discount to conventional commercial real estate. So I wouldn't be surprised if we see some capital market solutions in the shopping centre sector over the course of the next 2 or 3 years. But I think generally speaking, it's the part of the market which we would obviously say is not being provided for at the moment. Capital markets is not really there. I think we talked about it right at the start. Pre-GFC, I think CMBS issuance was about 50 billion a year. It's somewhere between 3 and 5 billion now. It's nothing.
Wow.
It's nothing. It's and there are a couple of major platforms that are pushing CMBS as a part of diversifying their own funding programs. But it really wouldn't surprise me if we see issuance levels increase. I don't think they're going to go back to 50 billion, but they will increase from where they are right now.
Okay. Really interesting. Chris, thanks so much for your time. Thanks for the insight.
Pleasure.
Really enjoyed it. Thanks.
Thanks, Sam. Thank you.